The U.S. tax system is a system based on the honor system. But there's checks and balances, something called substantiation. And I hope my marketing team can put those up in bright lights and maybe some stars and hearts. Something called substantiation. Substantiation means that while you can put whatever you want on a tax return, and that income, your expenses, what have you, the IRS, the Internal Revenue Service, will substantiate your claims. Now, they do that a number of ways. They can check your W-2s, your 1099s against what you actually report on your tax return. And in those situations, when they do not match, yes, it could lead to an audit. There are other ways that they substantiate. They will take a look at each and every tax return to determine whether there is something weird or funky on those returns. And each time that they look at a tax return, be it a computer program that looks at it, be it a person in the IRS, they will sometimes send out a letter for audit. And in those audits, you will have to substantiate those claims. Sometimes audits have nothing to do with something wrong on your return. It doesn't mean that you had crypto. It doesn't mean that you had too many expenses. It doesn't mean that something looked weird. It is completely random. There is no reason for them to come and look at you, but they do it on a randomized basis. Now, something to understand before we get into what exactly goes into an IRS audit is that the IRS very often is just looking for low-hanging fruit. They are a collection agency. They are looking to take in money that they would have lost if not for looking into a certain project. So therefore, when you get an audit letter from the IRS, don't freak out. It's not necessarily the fact that you did something wrong. It could just be your unlucky draw. Now, what happens when you actually get an IRS audit letter? What does it look like? What does it say? It says exactly what you might think such a letter would say. It says, you have been selected for audit, and we are going to ask you a series of questions to substantiate what exactly you filed on your tax return. Now, that is the same in whether you are a single practitioner, an individual with a W-2, whether you have a large business or a small business, whether it's a payroll tax audit, or whether it's some other audit. All that matters is that the IRS saw something they didn't like, or it was random, and they are going to ask you a series of questions. It is called substantiation, and you have a duty to substantiate each and everything that you claimed on your tax return. And that's something that the TikTok tax professionals, it's funny because I am one, but that is something that the other TikTok professionals that come on here and say things like, get the Augusta rule. You should pay your kids some of your income so that you can deduct it. You should buy real estate and take off all of the deductions that are special to real estate, or file as an S corp. What have you? All of this advice, while some of it may be good, it all matters not if you cannot substantiate that there was an actual business purpose for the position that you took, as well as that it actually happened. What comes in an IRS letter? An IDR, an information document request. The IRS is coming to look at what you said you did and what you said you have and whether you can substantiate it. Now, first things first, a letter came from the IRS. You might think, this is the government. This is my government. I pay their salary. I pay my taxes, we hope. So I'm going to handle it on my own. This is by far the worst mistake that I see from clients from all walks of life, whether they be hobbyists in their basement or people that run Fortune 500 companies. Each and every single one of them can make the same mistake, and it is always with disastrous effect. Do not contact the IRS by yourself. I know you think that you can send them all your receipts. I know you think that you can send them all your charity. I know you think that you can substantiate things on your own. But the fact of the matter is that they are trained for one purpose, and that purpose is to collect money that they would not have but for the fact that they audited you. So Would you talk to the police by yourself without a lawyer? No, you should not be talking to the IRS without a tax professional. And tax professionals are lawyers, CPAs, enrolled agents, or anyone else that has specialized knowledge of tax and how the IRS works. Now, those are two separate things that must be together. Keep that in mind. Tax and how the IRS works. So, you didn't contact the IRS, you went to a tax professional. What is going to happen? The IRS is looking for substantiation. I keep saying that word. Substantiation is multiple points of contact between the expenses or income that you claimed on your tax return and being able to show the IRS multiple places that give those proofs. Now, that is receipts as well as bank statements, as well as credit card statements. Third-party substantiation between yourself and the person or business that you either received money or paid money to. In all of those things, the IRS needs every single one. You took on the expense of putting together your widget, if you remember that from college days. So you had wood, you had plastic, you purchased something, you bought something, and you took that out as an expense on your tax return. You need to have the receipt from the place that you bought the wood product. You need to have the bank statement or credit card statement that shows that you paid it in order to show both sides of the transaction in order to substantiate your claim. And this will be on every single item on your tax return. Now, if the IRS is looking for something specific, which means you claimed you made $500,000 this year, but you have zero to pay over in taxes, the IRS may ask how and why. So in those situations, they may look for just the substantiation on the item that best lowers your adjusted gross income, which is the line item on your tax return that decides how much you are going to be taxed on. And in those situations, the IRS may just say in their information document request, just send me your charities, just send me your car statements, just send me this. But more often than not, once the IRS gets into your life and looks at everything that you've been claiming, there will be a series of questions. Substantiate your charities, substantiate your products, substantiate your health insurance, substantiate the fact that you have a 6,000-pound car that you heard on the internet you could deduct for nothing, and make sure that it is completely free. Show that it has a business purpose. You know, people forget that it's not just the fact that you made the expense. It's not just the fact that you paid for something. It actually has to have a viable business purpose. If it has no viable business purpose, then you don't get to deduct it. It's as simple as that. Substantiation again and again and again. It not only has to have happened, but it has to have a business purpose. And for that 6,000-pound car that you saw on the internet, you could deduct for the entire value of the $300,000 car and pay nothing on it because it's basically free. You better have, regardless of whether it actually is possible to do this, you better have your mileage. You better have its business use. And if you're in construction and your $300,000 luxury Ferrari is not really hauling your construction items to your construction sites, it does not have a business purpose. And you can be sure that the IRS will not stand for it. Now, there are other types of audits that have nothing to do with income. The IRS specifically has something called payroll. Payroll audits are when you have, exactly like it sounds, employees on payroll. But the interesting thing about payroll audits is that the IRS needs to be sure that you are withholding the correct amount of payroll for your employees. Now, some people may not be withholding the right amounts. Some people may have employees that are misclassified. They are classified as 1099 independent workers and independent contractors when they are really employees. And in those situations, the IRS will need substantiation for how you got to determine your withholding amounts as well as the fact that they are not employees. And if you're wrong, and if you can't substantiate, or if you just guessed, yes, the IRS will assess you for that missing withholding amount. And here's the interesting thing about payroll audits. Payroll audits don't just go as assessed against the company. They go and can be assessed against the person that is the responsible party for the business. So yes, you have people that work in your business, in your small business, maybe 1 or 2 employees, and you've been taking them off as 1099 independent contractors, even though they work 9 to 5 every single day and they are really bona fide employees. The IRS will come after your business for that money. And if your business can't pay that withholding amount and those penalties and that interest that the IRS has assessed, they will assess it against you personally if you are the person that takes care of the bank accounts and is the responsible person in the IRS's eyes. It is their money in your bank account and you stole from them, and therefore they can breach your corporate protections that you set up, your LLCs, your S-Corps, all the things that you know can protect you. In a payroll audit, it means nothing. They can come after you very much personally against your personal assets, your home, your car, your jewelry, what have you. So that's another reason why you do not want to handle these types of things on your own. You need a tax professional that understands those things and can guide you through it. Dealing with the IRS is a full-time job, and it is a specialized job that not just every single person can do on their own. You need that specialized training, much like you would from a doctor, from an engineer, from anyone else, that you would not do something on your own. You wouldn't build your own home unless you were trained to do that. You would not contact the IRS or any other state and local tax agency on your own. So what happens through the path of an IDR? You will provide the information that you do have. You will provide your receipts, you will provide your bank statements, and the IRS will go line by line and determine whether or not you have been truthful on your tax filings. Some things may not be so clear. Some people do not have good structures in place for how they handle their banking or their credit cards. They mix and match their business between their business expenses and their personal expenses, and it is all a mess. And in those situations, yes, you are inviting the IRS into your personal life when they didn't need to be there. An audit can balloon when you make these types of mistakes. The IRS follows a path of breadcrumbs, and if they follow that path of breadcrumbs from your business issues and your business account into your personal, it can be disastrous. So a very good advice for anyone, even before an audit, is to always keep your business accounts and your individual accounts separate, because the IRS will take that opportunity to jump from your business to your personal. And if it's all one mishmash of things, you can run into trouble. But you have substantiated what you could. You have substantiated some of your charities. You have substantiated some of your expenses or all of your expenses. The IRS will send you multiple IDRs as they go through the traveling of breadcrumbs to determine whether you have been truthful. And they will pull on each string until they reach their completion. And at the end of IDRs 1, 2, 3, 4, and oh yes, I've been to IDRs that have stretched into the teens, the IRS will finally come up with their assessment of your truthfulness and of your substantiation. They will say, we were able to substantiate this, we were not able to substantiate that, and they will disallow, or they could disallow some of your expenses or increase your income based on their analysis. They will, if your bank accounts say that you made more money in that year, you have to explain why you made more money or why it is not more income than you actually declared. If your expenses are too high or too low, the IRS will catch both of them. Yes, for better or for worse. Even if your expenses were more than you actually reported, the IRS will make those changes. For better or for worse, they will take the bookkeeping and they will make their assessment on your case. And at the end of it, they will send you an agreement to say, do you agree with this assessment or do you want to continue fighting? And that is when you have to make a choice. Do you want to continue fighting? Is it worth it to continue fighting or not? Now, for a few dollars, it's probably not worth it. It's going to be expensive and time consuming. But very often the IRS makes wild assessments, ones where even you did provide some substantiation, but it's not enough in their eyes. They can get more aggressive. And in those situations, you may want to fight. And in those situations, you can. There are ways to fight these assessments. You can appeal, and you can take things through an appeals process at the IRS or all the way to tax court, where you prove that what you did was correct. But you have to be sure that you are in it for the long haul. You have to know that the IRS has done this before to thousands and thousands and hundreds of thousands of taxpayers. You are one taxpayer. You have to determine whether it is worth it and whether the juice is worth the squeeze. And in those situations, you definitely do not want to take them on by yourself. You want a tax professional who not only knows tax, only knows the IRS, but also is proficient at handling tax court, which is a completely separate animal from all the other pieces that we've mentioned. So once the IDRs are finished and once the appeals are finished, you can head to tax court. And in those situations, you better know how to handle your tax court.